Welcome to Hedge Fund Tips with Tom Hayes for the week ending August 21st, 2020. Very exciting week, and this is our 44th VideoCast and our 34th podcast. So welcome once again, and as we do each week, we'll kick off with the media spots where I really condense everything that's going on during the week. First, we had CGTN Global Business from Shanghai, an appearance yesterday, and Michelle was asking me to comment on Alibaba's earnings. You definitely want to listen into that if you have Alibaba or are interested in Alibaba. Dan Loeb of Third Point, legendary hedge fund manager, reported a position for his recent quarterly filing. The key here is the cloud business is growing 3 times faster than its developed market counterparts. The Aliyun business, the cloud business, is basically looks like Amazon Web Services did 5 years ago. Amazon Web Services now has grown to be larger than the whole of Alibaba, including their commerce business and payments business, etc. So on that growth trajectory, Aliyun, they're obviously going to have the IPO of Ant Financial, which they own a third, so that's going to be worth $70 billion. So really granular on what businesses are really firing and how Alibaba's firing on all cylinders. And Michelle asked the right question. Well, it's run a lot. Can it still run? And my answer was simple. In the long term, for sure. In the short term, it wouldn't be out of the question to consolidate and pull back here, and that creates a long-term opportunity. But definitely check that out. And I want to thank Liang Ru for inviting me on the show. Again, Liang, thanks for having me on yesterday. And the next one, I want to thank Sean Langlois for featuring our article on MarketWatch yesterday, the article we're going to cover. And, he's an exceptional writer because he knows how to write a headline much better than I do. He said that 10 stocks positioned for an abrupt, which is a word that I used in the Lionel Richie article, which we're going to go through now, rebound when normalcy finally returns. None of them are tech. Now, in the Lionel Richie article, if you read it, the stocks that I feature were just randomly picked from the subsectors. They weren't stocks that I was endorsing per se. But when I went through his list, there were none that I disagreed with, so I just let it go. And I think it's useful to look at those groups because they will do well once we have the catalyst we're going to talk about in the rest of this podcast, VideoCast. So what was also interesting is, thanks to Sean, that this actually has become the most popular article on MarketWatch, which is one of the most trafficked financial websites in the world. So again, thanks to Sean for featuring this article. Be sure to check it out on the MarketWatch website, and we're going to go through a lot of the content that's included. I'd also like to thank Ellen Chang, who is a regular writer for U.S. News and World Report and for TheStreet.com. She's terrific, and she included me in her article on active investing this week. And my quote there, one of the reasons why, and she interviewed a lot of managers, but the point that I was making is the key reason investors want to have some exposure to active management is as a hedge against market cap weighted indices like the S&P 500. A handful of stocks make up almost a quarter of the weighting in the S&P 500. If and when those stocks, which are tech heavy, take a breather, you're going to have the benefit of a good active manager that has anticipated the sector rotation and put you in stocks set to outperform on a relative basis, says Tom Hayes. So that goes along with the theme of what we're going to be covering this week. Again, thank you, Ellen Chang, for putting that in your article in U.S. News and World Report. Next was Bloomberg covered me with regard to the dollar. Now, both Ellen's article and Moxie Ying's article here at Bloomberg, those quotes were from about a week or so ago, and they've just published this week, so it's not like all these were happening this week. But it was nice to be, thanks for Moxie and for Ruth Carson including me about the dollar. And the quote they stuck in was, I basically said, It said for Thomas Hayes, the dollar's downtrend is a signal to buy riskier emerging market stocks and commodities. Cheap dollar funding encourages risk taking and money flows into perceived higher growth locales. He favors emerging stocks partly as companies will have an easier time servicing dollar denominated debt. So again, thanks to Ruth and Moxie. And then finally, we had Reuters, Chibuke Ogu, thank you for including me in your article. And he was asking about the market action on Monday. And I was basically just saying we continue to see this push-pull between growth tech and cyclical/value stocks. It's a back and forth thing. The month started with a huge rally in cyclicals and value, and then it switched to tech and growth again. This was a weak week for cyclicals and for value, and it's just going to be push-pull until we get the catalyst that we're going to cover today. So now on to the article of the week. The Lionel Richie dancing on the ceiling stock market and sentiment results, also covered by Sean on the Market Watch. So do check it out. Sean Langlois. Check out all of his articles there on Market Watch. So let's get down to it. And I chose Lionel Richie's song Dancing on the Ceiling because I think we are experiencing that for a number of stocks, some of the tech stocks, and you all know the names, the Fang Plus and some of the Teslas, etc., that really had these monster moves and probably run a little bit ahead of themselves. It doesn't mean a catastrophic end of the world crash has to happen or anything like that. But I think you could start to see rotation once a catalyst kick in that would give a tailwind to those stocks that have lagged behind, and a headwind for some of these stocks that have already run significantly. So you could go through the lyrics and the song. It was fun to watch the video. I haven't heard this song in a long time, but it's just embodying, oh, what a feeling when we're dancing on the ceiling. And I think a lot of tech investors are feeling that way right now, but they might want to stay alert to some of these points that we're going to cover now. So in recent weeks, we discussed filling the late February gap on the S&P 500 and then proceeding to make new highs on the S&P 500. We've now accomplished both of those objectives. And while the implication and consensus is that we're at a short-term top, it's not really clear when we look under the surface. It's more of a Dickinsonian, and yes, that is a word. I Googled it. I wasn't sure if it was a word, but it covered. So
I found these results.
Basically, you have a situation where you have this Dickinsonian tale of two markets when you look under the surface. So while general indices could certainly be due for a rest in coming weeks, under the surface, that rest could be accompanied by under the surface rallies in laggard, unloved sectors. In other words, the conditions that would cause a pullback in the heaviest weighted names, the Fang Plus, Microsoft, etc., would potentially be favorable to those sectors that don't look anywhere near overdone at this stage. So you have the group that are dancing on the ceiling and testing shades of euphoria, and then other sectors firmly planted on the floor and ready to launch. So the question of what do you think of the market is much less interesting nowadays than a question of what do you think about banks, what do you think about commodities, what do you think about emerging markets, defense stocks, tech, etc., and parse it out on that basis. So for those of you listening to the podcast, we're covering a series of charts here, but it's basically sectors. So the first group I pointed out, it said, for example, do these banks look toppy to you? Any signs of euphoria here? So everyone's saying we're in a bubble, but when you look, I just randomly selected, it was, let's see, 12 large cap banks, and you can see they're all off the bottom from March and April, but barely, okay? So they're just sluggish until they get catalysts to the upside. So it just showed that they look nothing like a bubble. What about the energy sector? Is the bid for energy too frothy? Same look as financials. They're up off the lows, but they're, just kind of going sideways, looking, a little bit sleepy until they wake up. Then I did, so that was about 3 times 4. Yeah, that was about 12 or 16 stocks in energy I showed. Then how about defense and aerospace? I showed about 8 large caps here. Same type thing. They're moving up off the bottom, but not to the same extent as some of the dancing on the ceiling stocks. Then we showed casinos and airlines, a bunch of those that we just randomly picked, but they all look the same. They're up slightly off the lows, but just slowly coming up. And then we contrasted that. So those are all the dancing on the floor sectors: banks, energy, defense and aerospace, casinos, airlines, and then contrasted it to the basket of semiconductor, tech, and internet stocks, which you could see, if you're going to call anything bubble, these things were all at new highs and just running hot. And not necessarily at a bubble. I don't think, and as I've said in many recent weeks, I don't think that cyclical's performance coming out of the recession, as they always do, is going to be at the zero-sum expense of the high flyers. I think in the short term, it'll be a relative outperformance. But we know that the majority of the weight of the S&P comes from those top-weighted stocks, but so do the earnings. So there's, a symmetry to that. But in the fast growth periods of the recovery, when cyclicals outperform, namely coming after 2 quarters of negative GDP, which we've just had, they tend to gallop out. And that's really the point that we've been making in recent weeks. And what condition we need to see that relative outperformance for the laggards and the dancing on the floor stocks versus the dancing on the ceiling stocks is really, at this stage, it's going to come down to an announcement of a vaccine or a major breakthrough that points to near certainty on the timeline vaccine treatment front. And this would shift consensus from slower recovery growth / lower rates, which benefits tech, to the faster recovery growth, slightly higher rates, which benefits cyclicals. And the only thing really holding back record GDP growth right now, considering the amount of stimulus in the system and M2 money supply growth in the last few months, which we've covered in recent weeks, is certainty on the timeline of when normalcy will return. And this is a function of the virus, and each day that passes, we are getting closer to resolution. Now, I think Sean did a good job of pointing out this word, and I bold and underlined it in the Lionel Richie article. When these groups turn, it's going to be abrupt. And most people will be chasing the banks, for instance, after they're trading at a 50 to 100% premium to book value versus buying right now, when in many cases you can buy at book or even to a discount of book value. And most people are not going to believe the move when it starts to happen in laggard cyclical groups because there have been too many fake outs and shakeouts. So, but the move will be real, and they will wind up paying up after moves of 50 to 100% because the S&P weights will have grown and forced them, the closet indexers, to participate late rather than early. So you're going to basically see, when you have your Wells Fargos and your Bank of Americas and your JP Morgans trading at 1.5 times, 1.75 times book, you're going to have everyone on TV saying, we've loved financials and we're getting active exposure to financials. And you'll look back on these podcasts in recent weeks and say, I remember when we were talking about when Wells Fargo was trading at a 38% discount to book and no one wanted to touch it with a 10-foot pole. And it was the same thing if you look back to our podcast VideoCasts in mid-March and early April, when we were pounding the table on home builders and getting back in the market, and people were looking at us like we have 3 heads. You can go back and review those. And it's not about getting everything right, because the only way you learn to get things right is by getting a lot of things wrong and experience and living through some cycles and everything else. So no one uh, gets anywhere without paying up their tuition. But hopefully, analysis like that can help a lot of people shortcutting, particularly newer people listening in, shortcut, and professionals stay cognizant of the opportunities that are out there versus just looking at the cloud within the silver lining. So how do we know this is going to happen? Because a lot of people are saying, well, why? The economy's changed, the world has changed, everything's changed, so we don't need cyclicals anymore. There's no way, etc. I would refer back to Carl Icahn. I think put it aptly a couple years ago. He was on the halftime show. He said, "Scott, we can't tweet our way to prosperity. We actually have to make stuff," and to that I agree. But yes, things are changing, but you still need stuff, and the more technology facilitates productivity growth, the more demand there will be for stuff, and the more wealth that there will be, et cetera, et cetera. So it's just a question of timing in the cycle. So when we see that fast growth, these guys are going to rip. And the other thing that we know is that, and I've harped on the government and bank regulators need to lift the asset cap on Wells Fargo, is there is no recovery without banks and cyclicals leading out of the gate in the early high growth stages. Why is that? Because if you don't have credit growth, you don't have a recovery. Show me one recovery where you didn't have credit growth. And effectively, if the government falls asleep at the wheel on this, we'll have the W versus the V. I'm not in that camp, even though that's the consensus. I've always been a V guy, and you can just look through the past 3 months of podcast VideoCast. Leaving that aside, so banks are the transmission mechanism for the credit growth that's required to have a sustainable recovery. So what about sentiment? This week, we're going to take we put out the summary of Bank of America's monthly Global Fund Manager Survey. We cover this each month. It's about 200 managers that run about 500 billion of AUM, and they survey them and they get the answers. I'm going to cover some of the highlights. First and foremost is this month was the first month that after a 51% move off the bottom in the S&P 500, managers now feel this is not a bear market bounce. Well, okay, thanks for the insight. And in fact, the beginning of a new cycle, which we've been pointing to for several months now. Now, as I learned at the first hedge fund that I worked at, it's now more true than ever. Opinion follows trend. It doesn't precede trend. And that's exactly what you're going to see in banks and cyclicals. Right now, you couldn't give them away. In 2-3 months from now, and we're seeing a parade, a tidal wave rather. There was an article in Barron's, which I'm going to cover, of vaccine data coming out now, and it's when this switch flips, it's going to be like from dark to light. There's going to be no dimmer switch where you gradually fade it up and down and get into a romantic mood. This thing is going to go from off to on, and people are going to be skeptical, and then when a lot of these stocks double, then they're going to get interested, and opinion's going to follow trend. You're going to see it, and people are going to say, "Oh, tech got too hot." After tech's down, 20 whatever. Certain stocks will be down materially, and the same exact thing we said about home builders, the same exact thing, and you're going to see it. So, opinion follows trend. The trend has been down for cyclicals. It's going to turn up, and people will follow on board. Next, so the good news is sentiment is turning, though, generally. 79% expected a stronger economy. This was put out Tuesday. This is the highest since 2009, mid-2009, which was after a rally off the bottom, and that was also the beginning of the last cycle. So that's good to see. Enthusiasm is still tempered at just 17% expecting the V-shaped recovery. Most are expecting the W. So that's good because it gives us a further wall of worry to climb, and I'm happy to see that. Also, this tempered view is buttressed by managers' expectation that the 10-year Treasury yield will be lower than 50 basis points by year end. I will 100% take the other side of that trade. But that's just in line with people's outlook of where it's really recency bias. It's what's happened recently in the recent past is likely to persist, and frequently that's not the case. I'd be more inclined if someone put a gun to my head and said, will the 10-year be at 50 bips or 150 bips by the end of the year? I'd take the 150 bips, and that sounds crazy. There's absolutely no strategist out there that would call for anything even close to 125 bips. I think it's more likely to be 100, 110 bips. But by the year end, I'm telling you, once that vaccine is looking solid, you're going to see this thing change. A whole different sentiment and outlook is going to just take over market view. So also, respondents see an equal weighted portfolio of equities, bonds, and gold as the most overvalued since 2018. We're going to talk a little bit about gold. Obviously, the big news that and the elephant in the room that everyone wants to talk about is Buffett trimming banks and buying gold, and we're going to dig into that in just a minute. And the B of A proprietary bull bear indicator was up to 3.7. They said that is far from excessively bullish. 50% of the respondents expect higher profits in the next year, up 21 percentage points in the last month, and the highest level since March of 2017. So, more than a coin flip thinks profits are going up next year. That means 43% of people think profits are going down next year. With a vaccine, with 25% money supply growth, with all the stimulus in the economy, that wait till you get a little velocity, it's mind-boggling. And then cash levels are down to 4.6%, but that's a neutral range. You need to be below 4% to be kind of in a full-on greed, or above 5% to be in fear. That said, follow the money. They started to make the smart moves, in our view, that the direction at which things are moving, related to the dollar weakness. So emerging market equities rose 11 percentage points to net 26% overweight. Eurozone allocation increased 17 percentage points to a 33% overweight. That's a value play. If you're buying the Eurozone, you're making a bet on financials because they have weighting over there. So that's interesting to see. Exposure to U.S. stocks declined 5 percentage points to net 16% overweight. So coming out of the U.S., going into the emerging market and Eurozone, that's a dollar play. We'll see. When sentiment gets this certain that the dollar is going to continue to go down, you usually get a little short-term bounce. But I think the trend is correct. And this was the most important. Managers expect to rotate their investments into Europe, emerging market equities, banks, small cap, and value stocks. So that's the first time you're seeing an interest in emerging markets, value stocks, small caps, and banks. So it's nice to see that it started. It probably shook a few people out this week with the weakness, and that just creates the further opportunity for that when that light switch flips. This kind of general outlook was buttressed by the Leuthold Group, which you can find them on Twitter at Leuthold. They put out basically the same type charts that we've been putting out for months, but I liked them all in one place. He had the ratio chart of the NASDAQ to NYSE volume 10-week moving average, and effectively you're seeing it's at beyond record all-time highs, 4 times NASDAQ to NYSE volume, whereas in 2000 peak you had 2 times. So it's really gone off the charts. That implies that you want to be lightening up on tech and moving into nice, New York Stock Exchange stocks, more of the cyclical type stocks. The put-call ratio, which everyone's been bandying about as the reason for the market to crash and for everything to go to hell, is at lows not seen since in 20 years, since 2000. So they're pointing to extreme optimism, and you can't argue with that fact. you also did have that coming out of the last cycle in 2009 and 2010 at the beginning stages. So keep an eye on it. I think it relates more to what's overheated than it does to the general market, because as we went through those subsectors and sectors, they're not bubblicious. They're like just waiting to be picked up and rotated into. So and then finally, which we've covered extensively, but he did it as the AAII bulls as a percentage of bears is at a low, and they were pointing out that this is one of the few sentiment measures still showing a lot of caution, which has also confounded us as well. It's unusual to see optimism across the board in most indicators or near euphoric levels, and then pessimism in that one. So okay. So we've covered that, and the only way to reconcile these uncommon conflicting signals is to be selective. Trim what is run excessively and is due for a break, pockets where there is near euphoria, and buy where there's still pessimism, skepticism, reasonable valuation, and a durable long-term franchise. So then we moved on to the shorter term view for the general market. The AAII bullish percent was only at 30%. Usually you start to get cautious and want to trim when it's over 40%. So you're not getting euphoria yet. The bearish percentage was over 42%. So that, again, is just showing mixed signals. The CNN Fear and Greed, this, we write on Wednesday night, we post on Thursday morning, was at 68. So that's not, 80 to 100 is where it's like, okay, what can I trim? What can I trim? So it's bounced off. It came down from 74 last week. The higher likelihood is you get to froth euphoria, 80 to 100, before pulling back versus pulling back from these levels. Anything is possible, but we just really haven't gotten euphoric yet. With the exception of the National Association of Active Investment Managers, they were at 101% equity exposure this week. So they're playing the chase game, the performance chase, and so that's something to keep an eye on. But you see, we can go back, but in 2018 they did that, and that was only midway through the rally. You rallied for another four months. Similar situation in 2019. So the message for the week was that the signals are mixed. We've moved a long way in a short period of time, but while some stocks are dancing on the ceiling, like Lionel Richie, there's another half of the market dancing on the floor and ready to begin their abrupt upswing. The catalyst will likely come from science at this point. Don't bet against science. So we remain very constructive in the intermediate term. We are taking advantage of any buying opportunities in laggard cyclical names, and for now, keep on dancing while the music's playing, but keep your feet on the floor, and that's pointing to the stocks that are at good valuations and maybe lightening up on the ones that are have aggressive valuations at this stage. So this was the full Bank of America Global Fund Manager Survey. You can review it. It just basically has more charts that go through the pictures that we've covered. Most crowded trades still tech, but that came off the boil a little bit. And the contrarian trade that the biggest tail risk that managers were pointing to were the second wave of COVID. 35% of people were afraid of that. U.S.-China trade war, 19% of people were afraid of that. Although rhetoric lightened up a bit, Pompeo said that the Chinese were following through on phase one, so that's good news. The third risk was a blue wave with the election, because that would change corporate tax rates, although Trump has come up in the polls this week, as has the Republican Senate numbers come up a little bit this week. Dems still look like they're going to have the House for sure. And they could have the others too. It's early. It's very, very early, but it seems like there was an inflection point on the weekend that the executive orders to extend unemployment uninsurance were given. That's when the poll numbers bottomed and started to move up. And also after the Kamala appointment, I think there were people that were actually nervous that the VP was going to be Michelle Obama, in which case that would have been a very, very challenging ticket to beat. Now it's a fair game, and no one really knows what's going to happen, but that's where it's trending this week. Next week it could completely change again. One sentence, one this, who knows. Okay, and then 13% were afraid of a credit event. Now, the contrarian trades that Bank of America pointed to was, if you get a vaccine and rates start to move higher, long small caps and short tech. And also 70% of respondents thought that if the Senate flipped Democratic, that was a risk-off signal and would best be played by shorting healthcare stocks. I'm not sure that I agree with that completely. But that's what they put out in the report. So the most crowded trades are now, U.S. tech was at 59%, long gold was at 23%, and long corporate bonds was at 8%. Last week we covered that Stan Druckenmiller, the legendary billionaire hedge fund manager, was buying Wells Fargo even as Warren Buffett trimmed last quarter, 26%. But the key thing to keep in mind, which we covered last week, is Warren Buffett was trimming everything. I mean, he really sold J.P. Morgan, which was surprising, 63 some odd percent. Wells Fargo, he sold 26%. But you had guys like Druckenmiller buying. And then after we put out the podcast, we found out that David Tepper was buying of Appaloosa, who's just had staggering performance over the last 20 years. When Berkshire Hathaway is more leveled off due to the law of large numbers. So it was nice to see that. The other thing is, I totally understand the gold trade, and I understand inflation expectations, and I understand money printing. There are two things that I would bear in mind, because it was the same argument in 2009. I think this time the gold bugs will be more correct than the last time in terms of us starting to see real inflation, several years out. But what one wants to keep in mind, the S&P 500 is basically the strongest 500 companies in the world. So they benefit when Main Street struggles in the short term because they pick up share. So, two things you want to keep in mind is you are going to see a lot of defaults of small businesses, consumers, etc. And that's not reflected in the S&P 500 because there's no index of Main Street. So what Warren Buffett said why I think that this he bought a bunch of Barrick Gold, okay, or Berkshire Hathaway did. And why I think that this is a Todd or Ted play versus a Warren play. I mean, I'm sure Warren gave him the nod to put that kind of money to work. Is because, Warren Buffett came out for years he's been talking against gold. It's a non-productive asset, etc. And people are welcome to change their minds. I mean, he could come out on an interview with Becky Quick on Monday and say, listen, the Fed has told you that they're going to keep their foot on the gas until they have 2% symmetric inflation, which means they're going to get to 3 or 4% for a while until they start tightening. And I want some exposure to a gold producer to offset that. And I think that's a better exposure than, pricing power of Coca-Cola or some of the consumer product brands or some of the big companies that I own. And that's a reasonable view. And that could very well be the case for owning it in the short term. But over the long term, here's what he had to say about it. And this will kind of put some perspective. In 2018, Warren Buffett compared investing $10,000 in stocks versus gold starting in 1942. He chose 1942 because that was the first year he invested in stocks. So if you'd invested $10,000 in the S&P 500, what would be an index fund, even though they didn't have it back then, but just the general stock market indices, that $10,000 would be worth $51 million in 2018 versus gold, which would have only been worth $400,000. So and you had huge bouts of inflation over that 60, 70, 80, less than 80 year period. In the 1970s, off the charts. The early 80s, they had to raise rates to 16%. Some of you listening had mortgages that were 15% in the early 80s. So it's not like we didn't have inflation during that period and now we're going to really get inflation. No, we actually had a lot of inflation. We haven't seen inflation. It may be coming. But even with that said, if your outlook is more than the next 6 months and a 6-month or 12-month or 18-month trade, the long term, if you were betting on inflation in 1942, so one hand you put $10,000 in stocks, you made $51 million. Now keep in mind, in 1948, debt to GDP was, because of World War II, a different type of war. They had a visible enemy. This time we have an invisible enemy. They had to borrow to fight the visible enemy. We've borrowed a ton to fight the invisible enemy. But their debt to GDP got to 120%. So the case for inflation was very strong. And yet, stocks were worth $51 million by 2018, that $10,000, versus gold at $400,000. So you basically left $50.5 million on the table by using gold as your inflation hedge versus using the pricing power of stocks as your inflation hedge. And it's something to keep in mind here because that's how Warren Buffett has explained it for decades, and no one's better. So when you see this short-term view, I know Ryan Dietrich put out this thing, charting Warren Buffett's comments about gold. At the bottom, he was saying, gold is bad, and now at the top he's buying. I wouldn't characterize it that way. I think that's unfair. I think this is more likely a Todd and Ted thing. I think Warren, wants to hand over some of the reins. So unless it was an egregiously bad idea, he'd probably it won't hurt us in this environment, go for it. And that's exactly what they did. And it'll probably be a decent trade for sure. But over the longer term, which is what Berkshire is designed for, what's a better trade? And then the math is you can't even compare the outcomes. So when you think about chasing that. Now, there's another narrative going around. Why is gold outperforming? And that's because of duration risk for long bonds. So most people would hedge volatility and risk historically with long bonds. Now they feel the asymmetry is to the downside because you get no yield. And if rates go up, you're going to lose, 20, 30% or more of your principal and you'll never get that back. And I actually understand that thesis. I think it's more of a reason with a long-term view to be in stocks. But not everyone's at the age where they want to have an overweight stock, so that it's temporarily acting as a placeholder in that role. But I don't think that will be a durable strategy for the long term. It may be a trade in the short term. But when I just think about the comparison over time, you're not going to get inflation and the top 500 strongest companies in the world are not going to increase prices. It's just not going to happen because they have to pay their people more. They have to pay more rent. Real estate has proven to be a better hedge over time than gold as well. But if you want to have it for peace of mind and, a lot of prominent people talk about it, then you should do that. But just look at how the math bears out over time. In concert with our thesis about what's going to flip the switch, Barron's put out an article this week. A tidal wave of vaccine news is hitting the market. And Pfizer and Biotechny obviously was the big one. They're expected to get results by October. Then J&J has a 60,000 person trial. Moderna enrolling phase 3 from Pfizer and Moderna to enroll 30,000 people. J&J, a 60,000 person trial. Then you have that Gates company called CureVac that IPO'd, and they're in talks with the EU to sell 225 million doses. Novak. So look, as Fauci said a month or two ago, lots of shots on goal. Wait till it gets through the 5-hole and the switch is going to flip. The growth narrative is going to change. Cyclicals are going to rip. No one's going to believe it because they faked this out twice or 3 times in the last couple of months. And then, they're going to be chasing after the fact. Next, I thought this was pretty cool. Banks uncover loophole to buy home loans at below market prices. So effectively, you've got Wells Fargo and USB setting themselves up for a huge windfall. They are buying Ginnie Mae Ginnie Mae guarantees. So they're buying bonds from these funds that have to sell out because the borrower is in forbearance, so the value of the bond in the short term goes down dramatically, which is forcing the funds that hold them to sell them. But banks are buying them knowing that a large percent, number one, there's the insurance, and number two, a large percentage of them will become current again, and they're going to be, making doubles, and they're buying them in the billions and tens of billions. We'll get more color on that in coming weeks as they start to disclose that. But it was nice to see that. So U.S. Bancorp bought $5 billion of these loans for $380 million, and they'll probably trade back up close to par. I'm sure Wells Fargo in July and August bought $19 billion of loans out of Ginnie Securities for $1.5 billion less than the loan's market price, according to Divya Krishna. They don't disclose what the market price was, which was probably that similar discount to what we just saw from U.S. Bancorp. So, they could make 5, 10, 20 billion dollars off these type of deals because they have the accounting set up that they can do this and take advantage of it. So they're profiting from dislocation, and you're not going to see it until coming quarters. And it's probably going to be in line when we get the vaccine news, and everyone's going to say, well, that was obvious. They were trading at a 38% discount for book, except no one is on the same page with this. Just stay tuned is all I have to say. Now, it's quite feasible that banks don't recover, in which case then you have to say the BAML Bank of America Fund Manager Survey is correct, and we do not get a recovery. And that would be a scenario where banks don't recover because banks always recover dramatically in the early stages of recovery. But if you don't have a recovery, like if you're in the end of world, buy gold, buy bunker camp, then it's the wrong trade. But I have a different view, and so far it's been correct. When many people were pessimistic in March and April, you can go back and review our VideoCast podcasts and media appearances, and I think that's going to persist. I understand spike ups. I understand no one can predict the trajectory of what we can't control, which is the virus, but we can probabilistically bet that there are enough shots on goal that one of them is going to get through the 5-hole. We're going to have a vaccine, and everything's going to change. Now, I flew this week. I thought it was the easiest, safest thing I've ever done. I'll have to quarantine when I get back to Connecticut, but for 2 weeks, according to the rules. But everyone was wearing masks. It was totally safe. The airport, you punched in you'd go to the food court, they give you this stylus, you punch it in on an iPad, you don't even touch the iPad, and then it's delivered to you. It's like touchless payment, and you don't interact with humans. So it's there were no checkout people, it was just iPads. So they've adapted, and this thing, you see it in the TSA pass-throughs, or now whatever they hit, 880,000. I thought, maybe they'd be back up to half at 1 million or so. If you remember from a couple of months ago, we got close, but we didn't quite get there. So I think more and more people are going to travel, as there are more stories like mine and hundreds of thousands of others who are already traveling. But yeah, I would travel again next week and the week after. I mean, everyone's wearing masks, totally safe. Airplane, we know about the filtration systems are safe. There was no middle seat empty situation in my plane. It was full. It was great. The kids wore masks. We wore masks. No problems. So that's even before a vaccine. Wait till we have a vaccine. So that's good news to see. And by the way, you're like, well, how did you get all this work done? I mean, look, I work a couple hours in the morning, went to the beach a few hours, came back, worked a couple hours at the beach. We had an amazing time. Now, here's another article, as I say, that, when people say the world has changed. Okay, the website is Investor Amnesia. It was posted on the Big Picture, Riholtz's blog. And this guy, Jamie Catherwood is the name of the author. he has this chart, and I've talked about this in the past, how we had electric buses in the 30s, but his article is much better. He chronicles this company called the Electric Vehicle Company stock price from 1899 to 1907. And you can see it fell from $120 down to eventually down to $1 in a year and a half, and then it eventually went into receivership. It's not commentary on what's going to happen today, but because we don't know, but there were a ton of electric cars on the road in the early 20th century, and his article actually goes through all the data. So the Electric Vehicle Company was founded in 1897, and basically it went into receivership in 1907. During that period, the company issued 10 million of common stock, 8 million of preferred, and which is a huge amount of money 120 years ago, probably in line with what a lot of these SPACs are doing today, etc. And then it talks about, their range, by the way. The range of these electric vehicles was 180 miles. So they had close to the same technology 120 years ago. The electric car was invented almost 200 years ago. I mean, that I can't even imagine. In 1832, was built 50 years before the first internal combustion engine. Let's see. And this was in my Sunday reads last week. So if you either go to investoramnesia.com or go to the Sunday reads, and there's a hyperlink to it. During the 1890s, electric vehicles outnumbered other vehicles 10-1. And by 1912, there were 38,842 electric vehicles on the road. They had an early mileage range of 180 miles off a single charge. Sounds familiar. So let's see here. So you definitely want to check this out. Oh, and by the way, they had the whole thesis. They had trucks running off of electric to do that. They had buses running off of electric. All the things that people are saying, well, what if this happened, etc., already happens. So maybe this is the time that it actually sticks, or maybe it's just a repeat of what we've already seen historically. Only time will tell. Now, while vast consensus is running away from cyclicals, there is some smart money getting into cyclicals. We saw a lot of unusual options activity 1 to 1.5 years out for banks and energy, and we saw a lot of insider buying was concentrated in the same two sectors this week. So here's U.S. Bank Corp. There was a big buy. J.P. Morgan Chase, a big buy. AIG, a big buy. Raytheon Defense and Aerospace, a big buy. And then insider buying in Allegiant Travel, that's an airline. Insider buying in Texas Capital Bank shares, which is tied to both banks and energy. People have fled that stock because of energy exposure. The insiders are buying while everyone else is selling to them. And then Richard Kinder, who's been buying his stock hand over fist, bought another 373,000 shares this week, yesterday for $5.2 million. So while everyone's puking out, the smart people that are in the businesses are buying it from those people, and that'll continue to persist until until they rip. And in the case of banks, they're trading at 2.5 times book. In the case of energy stocks, 2 years down the road, trading wherever they'll be trading, like we saw from 2003 to 2007, when you had some inflation, when you had emerging market growth, and that's when the insiders will be selling it back to all the institutions who finally want them. Okay, now let's wrap up with economic data. Was again off the charts this week for the most part. Housing, NAHB housing on Monday, confidence was at 78 versus 73 expectations, off the chart. You also saw New York Empire State Manufacturing Index was down. That could be a one-off. It is New York as well, so just keep an eye on that. Building permits were up 1.495 million from 1.3 expected, 1.25 last month. That was huge. Housing starts crushed expectations, 1.49 expected, 1.24 up from 1.22. The energy had a big draw again this week, but it was less than expected. We only drew 1.6 million barrels versus 2.6 million expected. That's probably due in part to some of the regional shutdowns of the past few weeks, but now the Sun Belt's coming back online. Hopefully that'll go in the right direction moving forward. Continuing claims is the most important employment number. That beat expectations. So that came down to 14.8 million from 15.4 million. Expectations were 15 million. Initial jobless claims spiked up. Again, that's probably attributable to the Sun Belt, etc. They were supposed to be 925. They came in at 1.1. So that was a negative, but continuing is the more important number, but we got to keep our eye on initial. The Philly manufacturing was less than expectations, like New York. The U.S. leading index was up. U.S. manufacturing PMI, these were some good ones today, beat by a big margin. In expansion mode was 53.6, so that's for the whole country, so that was good to see, relative to 50.9 last read. The services PMI also crushed it. Expectations were 51. They came in at 54.8. Again, expansion over 50 versus 50 last read. Existing home sales crushed it. 5.86 million versus 5.38. Existing home sales up 24.7% versus expectations of up 24.6%. And interestingly enough, the rig count actually creeped up for the first time in ages to 183 from 172. And total rigs, that's oil, total was 254 from 244. So that's interesting to see some investment starting to kick in there. And lastly is earnings for the week. Again, just really off the charts. You had your Chinese companies like JD and Baba do great. You had a lot of the retailers do well. I just want to pull America's Car Mart. There's such a demand for cars these days. They crushed it. It's kind of like Carvana. Walmart, I think their online sales were up 97% or some crazy number, but they beat. Home Depot beat. Lowe's beat. Nvidia beat. Advanced Auto Parts beat. Just cover some of the highlights here. Yeah, we covered Lowe's. Target had a killer quarter. So just across the board, we continue to see good numbers. Baba we covered. And Deere crushed it, which was nice to see a cyclical knock the cover off the ball this morning, which was really, really great to see on Deere. So that's the story for this week. We're going to keep it short and sweet. I want to thank you for listening in. We're going to be back next week, same time, same place. Until then, thanks for listening and make it a great one.